Good morning, Canada. It's Saturday, December 13th, and this is Mortgage Rates Weekly. Big week. The Bank of Canada made their final rate decision of 2025, and if you're wondering whether your variable rate is about to change or if you should lock in, well, we've got answers. Here's the headline. Rates are on hold, but what happens next is where it gets interesting. Let's get into it. So, Wednesday's Bank of Canada announcement, no surprise here. They held the rate steady at 2.25%, which was expected. Governor Macklem had basically telegraphed this back in October. The bank said they're comfortable with where rates are at the low end of what they consider neutral, unless something dramatic changes. Let's put this year into perspective. 2024, the Bank of Canada cut rates 5 times, totaling 175 basis points of cuts. Then in 2025, we got another 100 basis points of cuts. It's a full 2.75% drop from the peak. So if you're on a variable rate mortgage, you've seen significant relief over the past 18 months. And now the question is that it? And are we done? Here's really what's driving the bank's thinking right now. Number one, the economy is holding up better than expected. Q3 GDP came in solid. There were actually upward revisions to earlier data that caught the bank's attention. Employment numbers have been surprisingly strong. The unemployment rate dropped 0.6% to 6.5%, which is a big move. But, and this is important, the bank is downplaying this. They've called it some signs of improvement. That's central bankers speak for, we're not convinced yet. Number two, inflation, it's behaving. Underlying inflation is sitting around 2.5%. The bank expects headline inflation to be close to their 2% target through 2026. There might be some noise in the short term. We'll see inflation tick up early next year because we're comparing against last year's GST holiday. But the trend is stable. Number three, trade uncertainty is the wild card. This is the elephant in the room. The CUSMA review is coming, and tariff threats haven't gone away. The bank specifically mentioned that trade-sensitive sectors remain weak and hiring intentions are subdued. The bottom line, businesses are nervous. The bank's exact words, the current rate is at about the right level to keep inflation close to 2%. While helping the economy through this period of structural adjustment. Translation, we're parked here unless something changes. Okay, so what does this mean for your mortgage? If you're on a variable rate, your rate isn't changing this month. And based on what we're hearing, it probably won't change for a while. Most economists, including BMO and TD, are now calling for no rate cuts in 2026. That's a big shift from a few months ago when markets were pricing in quite a few more cuts. The bank left the door open to cuts if the economy weakens significantly, but they also, if you squint, left the door open to hikes if inflation surprises to the upside. If you're considering locking in, and this is really where it gets strategic, fixed rates have actually crept up recently because bond yields have risen. The market was starting to price in the possibility that rate cuts are done and maybe even a hike next year. So if you're sitting on a variable rate and thinking about locking in, you need to weigh the certainty of today's fixed rates against the possibility that your variable rate stays flat or even drops if trade chaos hits. There's really no perfect answer. If you're risk averse and you're seeing fixed rates you can live with, locking in really isn't that crazy. Let's zoom out for a second. We've gone from emergency high rates in 2023 and 24 to a much more normal environment now. The Bank of Canada has essentially said, we've done our job and rates are really where they should be. The risk now isn't really about rate direction, it's more about economic uncertainty, trade policy, the U.S. election aftermath, and really global supply chains. And these are things that could force the bank's hand one way or the other. South of the border, quick note, the Fed cut rates again this week, but signaled they're slowing down too. They're dealing with stickier inflation and divided committee, so don't expect North American rates to plunge from here. The spread between fixed and variable is getting wider and closing in on 50 basis points. Historically, that's when variable starts to look more attractive from a cost-adjusted basis. Looking ahead to 2026, here's really what we're watching. In January, we have a Bank of Canada meeting, January 29th. Will they stay the course? Employment data. If jobs keep surprising to the upside, rate hike talks get louder. If trade uncertainty crushes hiring, cuts come back on the table. Also, the CUSMA timeline. This is really the big unknown, and it could reshape everything. So here's the bottom line for this week. Rates are on hold, probably for a while. The bank is comfortable with where we are, but really trade uncertainty means anything could change. If you're renewing in the next 6 months, now is a good time to start shopping and locking in a rate hold. Rates aren't spiking, but they're also not dropping either. The window for waiting for better might be closing. If you want to see what your best rate is for your specific situation, that's exactly what we do here at Every Rate. We compare over 60 lenders and show you the real options. That link is in the description. Subscribe and hit that bell if you want to get more of these updates every week. I'm Andy. This is Mortgage Rates Weekly, and we'll see you next week.